Again, thank you to everybody who has joined us for this session of the AgrAbility webinar series. My name is Paul Jones. I manage the National AgrAbility Project, which is headquartered at Purdue University. And our topic today is FSA Farm Loans. Our presenter today is Bridgette Wanhainen, and she's with USDA's Farm Service Agency. Those not familiar with AgrAbility, we are sponsored by the U.S. Department of Agriculture, and we focus on helping essentially anyone in agriculture with virtually any type of disability or functional limitation. Every one of the AgrAbility programs around the country is a partnership between a land-grant university and at least one nonprofit disability services organization. Currently, there are 21 state AgrAbility projects around the country. And again, there's one national AgrAbility project, which is at Purdue University through the Breaking New Ground Resource Center. Our partners on that grant include Goodwill of the Finger Lakes, Osteoarthritis Action Alliance, AgriSafe Network, Colorado State University, and Washington State University. If you'd like to know more about AgrAbility or view more than 160 of our archived webinars, you can check out agrability.org. Again, our presenter is Bridgette Wanhainen, and she is a Henry County, Indiana native, a Purdue University graduate, and an FSA Farm Loan officer who serves East Central Indiana. This time I'm going to stop sharing my screen and turn things over to Bridgette.
All right. Thank you for joining us this afternoon. I'm excited to discuss this. Again, this is more of a second tier to FSA presentation. And so we're going to discuss FSA lending versus commercial lending or traditional lending. So what financing is right for you? We're going to look over how FSA, what they provide and serve as terms of who we are, how our processing is different, what loan conditions might change for us versus commercial lender, and what tools we have available for you if you were to have a loan with FSA. So, general question of what's the word on the street? What are you hearing about FSA? Is our process too long? Is it overbearing? Is it a positive experience? Is it something that you have heard has really opened the doors for beginning farmers or distressed borrowers or anything like that? Typically, what we hear feedback on is that there's hesitation just because it is unlike traditional lending. But hopefully we can go over these things and we can shed some light onto some of those more hesitations that people might have, and we can get a clear idea what your relationship would be like if you had a loan with FSA. So who we are a government agency, clearly, but what does that really mean? We have to abide by all federal laws and regulations. And this is really important when we consider the environmental laws. It's a big part of what makes us different from commercial lending, and how our programs are funded and written in. A lot of it is tied to the Farm Bill. And so the Farm Bill, if you are unaware, is only rewritten every 5 years. And we were supposed to have a new Farm Bill in October, and we still don't have one. And so there are things that just haven't changed. And so this often leaves us limited in adjusting to the changes in agriculture. And look over the last 5 years of how ag has changed in Indiana, in the Midwest, nationally, globally. And if we can't really stay in stride with those changes, it makes our lending a little bit more difficult. And then also with government agency, we're often short-staffed, and it can be difficult to replace people who have retired, or to get people transitioned from commercial lending or just any other field of work over to FSA, just because it's a slow process. So we know those things. It's not really something we can change just because we are such a large moving pieces that can't keep up with things. So that is a negative thing, but also just part of working with the government, unfortunately. So other aspect I want to really touch on to clear up some confusion is that we are progression lending. So what does that mean? Stop and think, what is progression lending? What is that? What do you think about? What does that mean to you? And to us, we think of that as a stepping stone. FSA is a stepping stone in your financial success. So our goal is to assist borrowers to develop those skills. If it's in better improving their livestock production, or if it's in their plant production, their business skills, their marketing skills, their financial understanding, we help them to understand what those things mean, improve their business plan, to really work through those first few years, or if you're distressed, working through that hard time, to give you the tools that you need, that you can qualify for full commercial credit. Because if you didn't know already, we only lend to people who can't get credit elsewhere. If it's full credit or partial credit that we lend them, we try to help them through that transition or beginning stages so that they can go to a traditional bank, a traditional credit union, and be fully financed with them. So when you get to that point that you are strong enough in knowledge and finances that you can get full credit, we call this graduation. So what does that actually mean? What does graduation actually mean? You're going to refinance your FSA loan and continue on with traditional lending. A lot of people will forget about this when they make the loan, that we are not going to stay with you for the whole life of your loan. Maybe we will, maybe we won't, but most of the time we don't, because we're going to ask you to graduate. So what does that really mean? What is graduation? It's not something we would do right away, but we would do a financial analysis over your operation. We'd be looking at 3 years of tax history. We would have discussions with you about your goals and your plans, and is there any sort of transition happening? Are there any major changes that have occurred or that will be occurring in the near future? And we look at that, and then we do an analysis to see how strong of a borrower are you? How much equity do you have? How far have you come from the first time that we applied with FSA? And so looking at those things allows us to analyze if you're able to graduate. Some things that we do to assist you in getting those steps to graduate is that we do farm visits regularly. We may require you to take training. We send out newsletters to keep you in the know of things that are changing within FSA, or things that are just happening, like this AgrAbility session. We put that in our newsletter and send it out. So it might be something that people can tune into, give you resources that way. And just doing our regular financial analysis, our yearly one, just kind of being not a financial advisor, but just using FSA as a whole as your loan as a tool to get you to where you need to be, that you are financially strong. So I expect there will probably be questions about graduation, and we can really get into more details about that as we go on. But loan processing is probably the biggest differences that you're going to see between FSA and commercial lending. So what does that look like? First, we're going to look at the operating loan. So when you submit an application, we're going to review for completeness. And you have 30 days from the time you submit the application to get it complete. And in that time, we will send out 2 different letters. We review it once. We send out the first incomplete letter asking for any items. And then by the time that comes around at 15 days later, then we would send out a second letter for anything else that we don't need. And then we are going to start looking at our environmental review. This is one of the biggest differences with commercial lending. And because we have to carry out that other government agencies' policies and regulations and laws. And so abiding by environmental laws is a huge part of this, what we do. And this can be longer or shorter depending on what your loan action is. So if you are creating a large ground disturbance, say you're putting in a CAFO that has a manure pit, and you're going to have a stronger, larger environmental impact or potential to have an environmental impact versus if, you were just row cropping a field. And so if you're putting in a hog barn, that's going to take a longer amount of time to assess everything versus if you're doing row crop in a field that's already been row cropped, it will be quick and not necessarily easy, but you're checking within a mile radius. And so this can add some time, or it can just be, an extra day type thing. And then also at the same time, we're looking at the financial analysis where we're inputting your balance sheet, adding in the new loan, looking at 3 years of tax history or actuals. And then other component that we look at is your projections with not using 3-year averages. So we actually line by line put things together, or we ask for actual information from the current crop cycle that you're in or production cycle that you're in. And that's the biggest difference on the financial analysis, is that some banks and credit unions will just do a 3-year average. They don't look at what you've actually been spending and how the year that we're actually in is going. So if you were to apply in June of 2024, we would want you to submit your income and expense actual records from January 1st of this year till June of that year, and then project out what the rest of 2024 would look like. Whereas a lot of banks and credit unions, they're not going to ask for that information. They're just going to look at 3-year taxes and look at a crop plan or livestock numbers. It's going to be less in depth. And then, so 3, 4, and 5 are all kind of happening at the same time, but our loan write-up looks different too, because we're going to have a farm assessment write-up, and that's going to look at just an overview of what is this operation, what are your goals, what's the where the farm operates, who's involved in the operation, like a lot of details, and compared to some banks and other lenders, where we are also going to have a credit presentation, and the credit presentation is going to look more just at the specific loan that you are getting, the 5 C's of credit aspect. And so our loan write-up can take a little bit longer. Then after we've done all of that, we come to our loan decision. And if you're rejected or denied for whatever reasons, then we're going to discuss that with you, if it's over the phone or out at your farm or in the office. And we're going to give you the option to either, yes, I want to be denied or rejected, or you can withdraw the loan, or we can just kind of discuss things further and kind of see, is there any additional information that we can look at possible approval? If not, we'll send you a formal letter that will give you any of your options for what you can do moving forward. So if it's mediation or appealing the decision and going through that process. So there might be some additional questions that people might have on here, but the difference here in the denial part is that you can't appeal it, whereas with the other lenders, I haven't ever heard of an appeal process for that, but I guess it's a little bit more written out. I've looked at denial letters from other lenders, and I haven't ever seen an appeal option. So if you are approved for an operating loan, once we mark it all approved in the system and we get it, the amount of the money accounted for, like from the federal funds, then we will mail out the approval documents that then you have to sign and review and return to us. And it isn't until you return them to us that we can actually start doing our lien searches. So if you're building a greenhouse on a property, and you're using operating funds for that, then we would need to file a fixture lien. If you are just coming to us for an annual operating loan for your row crops, then we would file a UCC. And if you were doing a small construction loan and you use an operating loan for that, then we might just need to do like a local lien search and do those things. And so those things usually take 1 to 2 weeks by the time we actually get it filed, because we'll file it either with the county or the state, and those systems don't update every single day. But once we have the results from that, then we can close the loan, and with the loan close in office, you request how much ever money you wanted, and then you would have access to the funds within 3 to 5 days. So overall, the differences aren't too much from commercial lending, but it's typically overall less documents, limited to no environmental review. Some banks or lenders do some environmental review, but it's typically less than ours. Financial analysis, again, less in depth. The loan write-up is shorter. A big thing is that they can do pre-approvals where FSA can't. We have to do all that work before we get to that. And then they can order their lien searches ahead of time, which can just, like I said, that can take 1 to 2 weeks. And so that can be a long process. I've had operating loans where everything has just fallen into place, and I've done it in 2 weeks, where I've had some that have stretched out to 3 months. It really depends on how complete you have your application, and how quick you are to responding to any additional information, or responding to, oh, we've mailed those documents out, you need to get them back to us right away. And so I would say typically for an operating loan can be 1.5 months by the time you do it, which to some people is just not fast enough. So that's a real question you have to ask yourself: is this something I want to go into, or am I just wanting the low interest rate, but does it actually match my time frame? Are there any questions in the chat or anything? Are those being held?
See questions at this point.
Okay. So now we're going to look at a farm ownership or an FO loan and how that processing time looks different. So everything is the same. There might be a little bit more to write up, but more detail, but same questions. So everything's the same so far, but after we approve it, we can order the appraisal, and then we'll mail out the documents that you then have to return. And again, we can't do anything really to continue the process until you return it. And that would be the first step, is contacting the title company. Just say, we have a borrower or an applicant that has chosen your title company to close their loan. Can you do it? And if you can you fill out this information? We wait for that. At the same time, we're waiting for the appraisal. Once we get the appraisal back, we review it. And once we get that reviewed, then we can order the title work. And then that takes a big amount of time. The appraisal usually takes, the shortest I've ever seen is 10 days, but I would say that is abnormal. I would say it's normally 30 to 45 days to get the appraisal. Title work is usually 1 to 2 weeks. Once we receive it, we can then review the title work and close the loan. Closing the loan, we have to allow our funds to transfer because they're coming from the National Treasury. And so that can be an added time to it, because we have to get everything to work out on, can the sellers and the buyers and the bank and FSA's funds all be there on the same day? Can we find the same day to close? And so that can be difficult to correspond. But remember, our funds are coming from the National Treasury. And so we don't have the funds in-house. Not every FLP office has funds they can easily transfer. So it has to clear from National Treasury and be transferred into that title company's account. So overall, comparing again, commercial differences for a farm ownership loan, these are all listed with the operating loan. How, again, it's different is they can receive their appraisals more quickly. That if they have appraisers within their own business, or if they just have connection to a title, to an appraisal company that can turn around and do them quickly, that they can usually order them before we do. And then they can order the title work faster than we can, because we have to wait on you returning the paperwork and then have another conversation with the title company before we can really order it and get that appraisal. And then again, the transferring the money more quickly. They have it accessible and it can quickly set up a closing date. So overall, to me, there's not a huge amount of differences, but those differences, the small differences we have, do add up to a large period of time. So USDA recognizes that is a challenge, and so just in January 1st, this launched nationwide is application FastTrack, and is a new system that we can process loans. So it is going to be a shortened write-up. So the farm assessment about your goals and the type of operation and your 5 C's of credit, that is all going to be shortened. And then the financial analysis is a lot shorter. We're only going to be looking at the credit report, the balance sheet, and if you're applying for an annual operating loan, some basic production information. So we are not looking at any income and expense or production records or projections when we are looking at application FastTrack. So we still have to have a complete application. We still have to do an environmental, but like in the financial analysis and the write-up, that's the key differences. So we get that information, we run it in there, and if it generates a yes, can go through AFT based off of that credit report and that balance sheet, then we will contact the borrower and let them know that they qualified for this way of processing and give them the option if yes, I want to continue this way, or no, I don't want to continue this way. I've only done this 2 times since January 1st, and the one borrower said, no, I don't want to continue that way. I would like you to do a full financial analysis and really pick apart the operation and take a deep dive into my income expenses. And the other person was like, yes, please, this will cut down on the time. So it's really a matter of preference to you. You have the option. If you don't want to do it, you just have to put it in writing and provide that response to FSA. So one side thing to note is that when you're doing AFT for a real estate loan, it will automatically run it at a 40-year term. And then if you are doing an operating loan, a term operating loan, it will automatically run it at a 7-year term. So do you need a 7-year term? Do you need a 40-year term? Or would a 30-year term work better for you, or a 20-year term, or 25, whatever it may be? If you would like it to be run it at a shorter term, then you can also request that. So it's something to consider. But our standards with AFT is running it at the maximum number of terms. Okay. Any questions over loan processing?
We did have some questions in chat.
Okay.
I'm not sure if you want to address these right now, but
it's up to you how you kind of want to run the meeting, but
yeah, why don't we go ahead and I'm not sure they're specifically related to what you just covered, so we'll cover them at the end.
Perfect. All right. So loan conditions. These are things you really should be paying attention to when you're thinking about entering into a loan with FSA, or if you're entering into a loan with other lenders. I see the interest rate, I see the term, and that's what I'm interested in. And then when it actually comes to closing day, it's like, okay, here's the fine writing. What are you actually signing up for? What are you agreeing to? And so I'm going to break it down into typical OL loans and FO loans. So if it has an asterisk by it, that means that it's FSA specific. So the borrower must be the owner and operator for the life of the loan. We are not in the business to assist investors or businessmen, I guess to say. We are here to help farmers. And so if you get a loan with us, you will be the farmer. And if you are not the farmer, then you will have to refinance your loan. How do we know if you're not the farmer? You're not going to show up in farm programs, FSA farm programs. You won't have a record of farming. You won't have crop insurance records. You won't have it on your federal taxes. So we look at all those things. And if you're not reporting to farm programs that way, we can easily see that. And so I have ran into this a little too many times. So this is why it's number one thing on our list of conditions. Other ways we see this as it's not somebody purchasing land and then renting it out to people. It is they apply with FSA as an individual, and then over the years they have now formed an entity. And now the farm we assisted them buying, or the farm that they rent and they operate, they are now running it under their LLC name and not the name that is on our loan. And that's not allowed because farm program and farm loan program systems talk to each other. And if they do not match, information can be missed. Payments can be misapplied, qualifications and for programs and things can be interpreted incorrectly. And so if you are not the owner, if you are not the operator or the owner, then you're going to create a lot of issues, and some things you'll get notified that we have discovered it, and sometimes it's an honest mistake and other times it's not. But you get notified of, this is how you can get this corrected. You have so much time to get it corrected. If you don't get it corrected, then we're going to proceed a route to you having your loan refinanced. So again, FSA is aiming to assist beginning farmers, socially disadvantaged farmers, distressed farmers. So we want to make sure that we have it correct and that our systems are matching so that our programs and our policies can be carried out correctly. So that's FSA specific. Another typical condition for all loans is that you're going to annually submit your production records, your taxes, your balance sheet, your projections for that crop plan. That's not abnormal. A lot of banks do that. I'm not going to say every bank does that, but check in on your financials, making sure that you're in good standing. Consulting with FSA on any major changes to your operation. That's not FSA specific either, because but I wouldn't say it's for all other lenders either. We want to know those things because we want to be made aware if you have gotten a divorce, or if you've have medical issues that now we need to adjust your crop plan. We want to know if you switch from raising pumpkins to now you're row cropping. We want to know if you've taken on a home loan or anything like that, just so that we can make sure our security is in check, and then also make sure that we are reviewing your operation with all needed information. So when we do our operational reviews, we want to know those things so that we can have a true assessment of, are you on track to graduate? That makes sense to everybody. Just being in the know, keeping good communication. And then we review the loan to make sure that we are following environmental regulations, but then you have to continue to meet that through the life of the loan. So what does that mean? A lot of times we're dealing with don't convert wetlands. If there's a wetland on your property, you can't convert that. Don't tear down trees without getting consultation. That it's usually not too difficult to do. A lot of times manure application, making sure you're doing that correctly. And it's not like we're going to force you to refinance your loan, but you will need to get it corrected. So if you do some things that break environmental laws, then you could be at, you could maybe face like fines and repayment for things. But it's just something that if you purchased a property with FSA funds and you are then asking FSA to finance your operation further, you need to make sure that you continually stay in compliance with environmental laws. And then farm visits, we usually see, at least in our office here in Newcastle, we see our borrowers who have operating loans every year and then every other year for anybody who just has real estate. So it can depend if you want to be seen more often or if you're a stressed account or anything like that, but at least every other year. And again, most banks that have farm loans are doing that. Other typical conditions for an operating or farm loan would be maintaining insurance for the life of the loan. If that would be just liability insurance, real estate, equipment, for your livestock, for your inventory, considering all those things, FSA will want you to maintain that insurance, and FSA will have an assignment on that if we are taking that particular thing as security. Production and financial training is specific to FSA. We can make that a requirement, again, because we are progression lending. You would have 1 to 2 years to complete that training. It's online, it's self-paced, and you have to pay for it yourself. It's pretty easy. We have 3 different classes that we can offer, and I've heard really positive things about it. It's good for a refresher course, or is it a good intro course? Borrower's going to have to pay for all recording fees. FSA does pay for the appraisal if we order it ourselves, but if your participating lender orders for appraisal, then you'll have to pay for that. But your mortgage fees, your UCC fees, title company fees, you will have to pay for that yourself. FSA can also take assignments on your commodity checks. So if it's an annual operating loan for a grain operation, we'll take an assignment on grain checks. Assignment, again, I already said on insurance. Assignment on FSA payments. So ARC PLC, if it's an EQIP, if you have an EQIP, then we can take assignment on that. We can even take an assignment on your rental property income if need be. I've never done that. Don't really ever hear of people doing it, but if it's that tight, we can do that. And then one of the biggest things of what makes FSA different is what we take for security. So our security is not just equal to the loan value. It can go above the loan value. Why? Because we're helping distressed borrowers. So people who have a greater risk rating, beginning farmers, socially disadvantaged farmers, people who aren't getting full credit elsewhere. And so how do we compensate that bigger risk? With more security. Key thing is when it's available. So we'll take additional or extra security above 100% when it is available and if the loan type requires it. So I've broken down all the different examples for you. If it's a micro operating loan, 50%, $50,000 purchasing cattle, that's 100% security because it's micro. It's going to be $50,000 or less. If it's a term micro, but it's a specialty crop, so you want $20,000 to purchase equipment to process maple syrup, then it's going to be 150% security. If it's a term operating loan, say you're purchasing a tractor, then it's going to be 150% security. Annual operating loan, if it's micro or not micro, it's going to be 150% security. And then micro farm ownership, just 100%. If you want to use some funds to make some improvements to your barn, and you don't need that much from us, it's under 50,000. We're just going to require 100% security. Direct farm ownership, where you are financing a farm purchase, 100% from FSA, 150% security. Again, if you have it, If you came to us and you needed us to finance the farm purchase 100% through FSA, and you already own your home, then I could take a mortgage on the farm we assist in purchasing, and then a second mortgage or a third mortgage, however you finance your home in the first place, on the home. But if you rent your home and this farm purchase is all you have, then I'm not going to be taking anything else. And then again, participation, if there's two lenders, FSA, and then another lender involved, then 150%. If there's a down payment loan for real estate purchase, then it's just going to be 100% because you've helped mitigate that risk by putting the 5% down payment on. Okay. Other typical conditions would be a partial release. That's when FSA lets go of security. You would have, that's a separate loan action. With every loan action, we have to do environmental review and consider graduation as a possibility. So typical, or some examples of it would be taking acres out of production. Say you bought bare ground and now you want to parcel off 3 acres and have a little farmstead and home, then you would have to request a partial release with FSA to take those acres out of production. And why do we have to ask for that? To make sure that those number of acres isn't going to be detrimental to you paying us back. Selling acres for whatever reason, using additional security for a different loan. There could be lots of different reasons. We've even seen it for exchange of security. Maybe we took something else as additional security before, but now over time they've picked up another piece of real estate and they want that other security to be released. There's lots of different reasons, but this is a little bit more. Other banks do partial releases and other lenders do partial releases, but our regulations are a little bit different and slower moving. And again, we have to do an environmental review for it, and we have to look at graduation. And then same thing for subordination. What is a subordination? Where we allow other creditors to come ahead of our lien position. We often see this if we took a home as extra security and then they want to, if they go out and they're trying to get a home equity line of credit, and FSA, they see FSA on there, or they don't want to be in a third mortgage position, then we would maybe need to then subordinate to that bank so that you could get that line of credit. Or if we've taken extra security, say you came to us and we helped you purchase livestock, but then we also took your equipment as additional security, and now you are going to be getting another loan and they want that equipment as additional security, then we can subordinate our position to that, not release it, but subordinate it. So, and then we see it often too with refinancing. So LOL, OL additional requirements. So if you're operating, this is FSA specific. You have to use or return your funds within 6 to 12 months. So if you get a $30,000 annual operating loan and you only use 20,000 of it, then you would need to decide, okay, do I need these funds or do I need to return them to FSA? If you return it to FSA, they go on your principal portion of your loan. You don't readjust your payments, but that just goes towards the principal, which is a little different. And then you also have to provide receipts or quotes for any of your draws, just to make sure that you are spending it as you said. Again, these are for FSA funds. So to produce the commodity that you said you would be using. So you can use it on family living as well, but not to go and purchase a vehicle. You can't go and use it for your vacation. It is for the farm, but it can't support, pay the electric at the house and farm or things like that. And then for our annual operating loans, our annual loans are not for like a 12 months of I can spend it on whatever. It's for that crop production cycle. So I had an issue earlier this year where the person thought they were getting an annual operating loan so they could go purchase equipment with it. They could use it here, they could use it there, but an annual operating loan is just for that production cycle. So the example here for a blueberry farm, you could use it on marketing, you could use it on harvesting, you could use it on packages, you could use it to for any hired labor, if you needed to pay those, people that were assisting you, but you can't use it to purchase a blueberry harvester. So that's different than other line of credits. A PAD agreement is where pre-authorized debt, we can make that an assignment. If you don't have an assignment, then we can use that to ensure repayment, where we have you set up on automatic weekly, bi-weekly, monthly, quarterly, semi-annually payments, just to kind of ensure repayment if it's a riskier loan. Borrower again has to pay fees for the UCC, but in this case, it's to update, continue, or release your UCC. So UCC is only lasts 5 years, where some operating loans last 7. So there's changes that might need to be made to it. We'd have to pay for those. Then consult with FSA when selling and trading securities. If you are selling livestock, and livestock's your main commodity, and you don't have the ability to repay us with those sales, or you're not intending to repurchase, then we just need to talk about, okay, how are we going to use these funds to help your operation? We took equipment as security, and you just sell it and you don't replace it. Now we don't have any security, and you didn't put that money on the loan. We have issues. FO conditions that are kind of a little bit more specific. Not as many. Subject to participating lender. If we approve our loan and then the other lender doesn't approve their portion, then we can't finance it. So we have to make sure it works out on their end. The property must appraise out. It's kind of difficult these days when ground is going for more than it's worth in some areas. And then we do an appraisal and your purchase price is higher than what it appraises for. Well, if it's higher than it appraises for, then that means I have less security. And so you either need to find money to make that difference, or you need to rework your purchase agreement. Down payment must be paid at the time of closing. That's not specific to FSA, just something to consider what that down payment is. And then if you use a construction loan with us, then you're going to have a supervised bank account. It's not going to be like a line of credit or anything. It's going to be, you ask FSA for funds. There's a separate bank that I would write checks to, and then you would sign off on, and funds would be released that way. So that's a little bit more specific. Some emerging tools that FSA has created over the last 2 years. We have a loan discovery tool, and that kind of helps you learn a little bit more about what types of loans we have. The loan assistant tool is going to assist you more with our forms and applying. Farmers.gov, they're really pushing that. If you have an account, that you can do a lot more with it. Specifically in the last couple months, you can now apply for FSA loans online. Right now it's just limited to individual applicants, and then you can also start paying your loan online. And all those links will give you more information about that, and you can also contact your service agent, your service center. We've also made our application a lot shorter and user-friendly. So if you already have an FSA loan with us, it's a lot different than it was a year and a half ago. So we also provide servicing options. That's something you really should consider, is loan consolidation. If you can't make payments, basically refinancing, rescheduling your payment, that'd be a servicing option. Extending your loan by reamortizing, deferring payments. If the rates are too high, maybe you can switch your rate to a lower rate for a short time being. If the rates right at that time allow it, debt write down when anything else doesn't work. And then if there's a couple other specific options available, but know what your options are and what those restrictions would be. Sometimes at lenders, you can do these things quickly and easily, whereas FSA, we might have to get a little deeper into the weeds, I guess, on your financials to really see which option would be right for you. Well, that's all I have. Sorry I went a little too long. I didn't give too much time for your questions, but there's my email and my phone number. Feel free to contact me, and I will do my best to get you in the right direction. If it's answers or examples or resources or finding the right office and people to talk to.
Thanks so much, Bridgette. We did have some questions in the chat, and I'll go ahead and read those for you. A couple of them were, I think, related to one another from different people. One was, can a farm loan be used for a startup farm or undeveloped land purchase? And then similarly, there was a question that said, are people just starting agribusiness approved for operating loans? There would not be 3 years of farm-related finances to review. So both kind of questions about beginning farmers.
Yes, the undeveloped ground that hasn't, I guess, traditionally been farmed, you could farm that as long as there aren't any environmental issues with it. That'd be my first hesitation with the property like that. Why hasn't it been? And then you wouldn't be able to, if you were row cropping it, get crop insurance for that first year. And that's not an issue for us. It could be for lenders, but if you can't get crop insurance, because you have to have 1 year of history to get crop insurance. And then your question about getting an operating loan. For an operating loan, you have to have 1 year worth of production experience. So in the commodity that you would want to be producing, if it's raising chickens, if it's raising cattle, if it's produce, if it's row crops, if you want an operating loan, you have to have 1 year's worth of experience in that. If it's you doing it directly or you assisting with it, but having enough knowledge and skills equivalent to 1 year to do that. Whereas farm ownership, you have to have 3 years worth of experience, but it's a little bit more spread out over business skills and production skills. So does that answer that one? I feel like it does. Every loan and application is specific, and so your experiences and your knowledge are going to change how you meet that eligibility.
Okay. Another question, can a portion of land be used for collateral for a loan?
A portion? It depends on how that legal description is written, I guess. You would probably need to parcel it off if you wanted to do that. You couldn't just, like, if it's broken into 3 different parcels, but the legal description has them all together, then no. But if you had those 3 different parcels and you exempted one of the parcels from the original legal description, then yes, because we have to make sure that it's identifiable.
Okay. Another question, and if you do have anyone out there who has more questions, feel free to enter those in the chat, or again, you can use the raise hand icon to raise your hand and we can let you ask questions verbally. One more that was in the chat. Can the operating farm be set up as an LLC if you are the sole owner?
Yes. Yep. So any questions about LLCs and if you should do an LLC or S Corp or a C Corp or anything, that is all legal questions that I am not qualified to advise you on how to set up, but you can apply as an LLC if you are an individual or a couple or whatever. However you plan to operate, you have to answer those questions before you apply on how you want to do things.
Okay, and then another question just came in. Does all that have to be done before the loan application is submitted?
Yes. I mean, if you can apply as an individual and close your loan as an individual, and then you can form an entity, but that property must show up on all farm programs within FSA and NRCS as your individual name. So if you think you're going towards an entity, then I would form that entity prior to applying if you're in these beginning stages. If you don't want to, or if that's not something where you're at that point, and then you do form an entity, that entity can assume the loan, and then everything will match correctly throughout our programs.
You mentioned security and extra security. Can you give examples of what security might be and how you identify those?
So security, we're a little bit more creative in our security than lenders. So we can take things that other people, that they might not. I did an operating loan for a Amish dairy farm, and I took the mules and cows that I helped finance, but I needed additional security. So I also took his personal horse, his personal carriage. I took some equipment that he had on halves with his cousin. It can be personal or it can be farm. For another operating loan example, it was for produce. We did an annual operating loan with them, and so I took. It's difficult to value produce in that inventory. It's a short lifespan, and so I filed a UCC, and then the actual security for that was the refrigerators, the tractor, the bush hog, and the tiller. Like, it can be lots of things, as long as there's not a prior lien on if someone has like a snowmobile and there's a title on it already. If they don't hold the title, and if the bank holds the title, then I'm not going to take that because they have the title. But I've taken a dirt bike, I've taken a snowmobile, I've taken personal vehicles, trailers, anything that has equity. I've taken inventory. Yeah.
Collateral, basically.
Yeah. Anything on the left-hand side of your balance sheet.
And the term UCC, what does that stand for?
Uniform Commercial Code.
Okay.
Yeah, that's for filing a lien with the state or the county, depending on what type.
Okay. A couple more questions have come in. For a farm loan, who makes the inquiry to potential commercial lenders, the applicant or FSA?
What's the question?
For a farm loan, who makes the inquiry to potential commercial lenders?
Oh, the applicant. Yes. Mm-hmm. Yeah, we work with a lot of different banks and credit unions that have ag lending experience, but it's totally up to you on which you go with.
Okay. Another question. I plan to start out small, selling to local restaurants and vendors. How much production do I need to qualify for a loan?
So there's not a requirement. Starting off small, our concern would be over, can you make at least the principal payment on the farm debt with just the farm income? Because that kind of equals it out. Is it worthwhile? Is it a smart financial move? But then we look at your non-farm income. How strong is it? Like, if you're starting off small, and you have a strong non-farm income, is the chance that you repay your ag loan high? And starting off small, what's the potential for growth? So there isn't a set number or anything, but that's kind of, you can sit down and work with FSA to go over those numbers, but you really got to be doing the work of who are you going to be selling to, what quantities do they need, what prices are they willing to give you, how many months a year can you actually produce that. You really have to look at those details before you kind of come to us. We can advise people and to the right resources and things, but we don't have the manpower to put together a crop plan for everybody. But the small business development centers, they have an ag sector that can assist you, and they are free for a little bit more of that prep work.
Small business development centers, is that what you're referring to?
Yep.
Okay, great. Well, we're almost to the top of the hour. I've got one more question in the chat. I do want to remind everybody to please respond to the survey that should pop up in your browser after we close the session. This last question says, this individual is an urban farmer that produces year-round. I grow vertically microgreens, herbs, and baby veggies. Can a business like mine get a loan? I'm a veteran and I am disabled and still can't get a loan.
Okay. Yeah. Sounds like you're clicking on a lot of our boxes. As long as you meet all eligibility, we do urban loans, urban ag loans, as well as just traditional farming. So I would definitely send me an email and I can connect you. We actually just started having urban ag service centers. I don't know where you're located, but the nearest one to Indiana is Chicago, where they kind of focus on assisting urban farmers through the USDA programs. But send me an email. I can kind of get you in connection with those resources and you can go from there.
And I did just enter the link to the website I just found on the FSA site for different offices around the country if people are interested in checking that out too.
Perfect.
Okay, I think that's all the questions we have for now. I just want to thank Bridgette for all that helpful information. We do have our contact information there. And again, there are lots of resources on the web for locating FSA offices in your area. Thank you, Bridgette. Thank you for everyone that participated today. And we wish you a good rest of the day.